Imagine a time of prosperity, a time of jazz and flapper dresses. America, in the 1920s, was on top of the world. The Great War was over, and the economy was booming. People were investing in the stock market, confident that their investments would continue to grow. From Wall Street to Main Street, a sense of optimism prevailed. New technologies like the radio and the automobile were transforming American life. On October 24, 1929, the stock market experienced a significant drop, shaking confidence, but not yet causing widespread panic. However, the worst was yet to come. 5 days later, on October 29th, a day that would forever be etched in history, the bottom fell out. Black Tuesday. Millions of shares were traded at plummeting prices. Investors, gripped by fear, desperately tried to sell their stocks, but there were no buyers. The crash of 1929 had begun, signaling the start of the Great Depression. The 1920s dawned brightly in America. World War I was over, and the United States emerged as a global power. The economy surged, fueled by industrial growth and technological innovation. For many, it was a time of unprecedented prosperity. Cities thrived, their skylines transformed by towering skyscrapers. Automobiles, once a luxury, became increasingly common, transforming transportation. The sounds of jazz music filled the air, capturing the energy and optimism of the era. The proliferation of new consumer goods fueled a spending boom. Advertising played a key role in promoting these products and fostering a culture of consumerism. People were encouraged to buy now, pay later, thanks to the easy availability of credit. Installment plans became increasingly popular, allowing consumers to purchase big-ticket items with small down payments. The radio, in particular, became a symbol of the decade. Families gathered around this new invention to listen to music, news, and entertainment. The radio also became a powerful tool for advertisers, reaching millions of listeners. The stock market, once the domain of wealthy investors, became increasingly accessible to the average American. As more people entered the market, stock prices soared, fueled by speculation and a belief that the boom would last forever. The optimism was palpable, and people borrowed heavily to invest in the market, hoping to get rich quickly. This borrowing was not without risk. Margin buying, the practice of borrowing money to purchase stocks, became increasingly common. It allowed investors to buy more stock than they could afford, amplifying both profits and losses, creating an illusion of wealth. This illusion was dangerous, as the stock market was becoming increasingly detached from reality. The disconnect grew, driven by speculative investments, fueled by the hope of quick profits, further inflating the bubble. This bubble was fragile, and the lack of regulation allowed for risky financial practices to flourish unchecked. These practices included margin buying, which played a crucial role in this house of cards. Borrowing to invest created a fragile financial structure, where any downturn could trigger massive sell-offs. The speculative bubble, built on borrowed money and unrealistic expectations, was destined to burst. When it did, the consequences were devastating, leading to financial ruin for many. The 1920s, often referred to as the Roaring Twenties, was a period of great economic prosperity and cultural change. People were eager to invest, believing that the good times would never end. This era of exuberance and excess set the stage for the eventual collapse. Banks and financial institutions played a significant role in this speculative frenzy, often lending money without proper safeguards. When the market began to show signs of trouble, panic set in. People rushed to withdraw their savings, leading to bank runs and further financial instability. The crash of 1929 was not just a financial disaster, it was a psychological blow to the nation. The dream of easy wealth was shattered, and the Great Depression that followed brought widespread hardship and suffering. The house of cards had collapsed, leaving a legacy of lessons for future generations. Economic factors played a significant role in the crash. Overinflated stock prices, driven by speculation and margin buying, created an artificial bubble that was bound to burst. Excessive debt was another critical factor. Many investors borrowed heavily to buy stocks, increasing their potential gains, but also their risk. When the market turned, these investors faced massive losses and were unable to repay their loans. The weak banking system, poorly regulated and heavily invested in the stock market, suffered significant losses when the market crashed, leading to bank runs and failures. The prosperity of the 1920s was not evenly distributed. While the wealthy grew wealthier, many ordinary people struggled financially. This limited consumer spending and made the economy vulnerable to shocks. Overproduction and underconsumption also contributed to the crash. Industries were producing more goods than consumers could afford to buy, leading to declining prices and profits. Federal Reserve policies, including the decision to raise interest rates in 1929, made it more difficult for investors to borrow money and contributed to the market downturn. Loss of confidence was another factor. As the market declined, investors panicked and began selling off their stocks, further driving down prices and creating a downward spiral. The US economy was interconnected with the global economy, which was also experiencing a downturn. This exacerbated the problems in the US, contributing to the crash. The combination of these economic and other factors led to the devastating crash of 1929, marking the beginning of the Great Depression and leaving a lasting impact on the world. Not everyone was caught up in the speculative frenzy. Some astute observers, including economists and business leaders, recognized the warning signs and cautioned against the excesses of the market. They pointed to the growing gap between stock prices and actual corporate earnings, warning of an impending correction. Roger Babson, a respected economist, famously predicted a stock market crash in 1929. He warned of overspeculation and unsustainable debt levels, but his words were largely ignored. Despite these warnings, the speculative bubble continued to inflate. The stage was set for a dramatic and devastating collapse. The first tremors of the impending earthquake were felt on Thursday, October 24, 1929. The stock market, which had been steadily climbing to dizzying heights, experienced a sudden and sharp decline. Nervousness rippled through the financial district as investors began to sell their holdings. Trading volume surged as investors rushed to unload their stocks, overwhelming the ticker tape system. By the end of the day, the Dow Jones Industrial Average had plummeted by 9%. News of the market's plunge spread like wildfire, reaching beyond the walls of Wall Street. Fear began to grip the hearts of ordinary Americans, many of whom had invested their life savings in the market. Friday, October 25th, brought a brief respite from the previous day's turmoil. A group of prominent bankers, led by Charles Mitchell of National City Bank, intervened in an attempt to stabilize the market. They pooled their resources and bought large quantities of blue-chip stocks, hoping to restore confidence. Their efforts seemed to have a calming effect, at least temporarily. The market rallied somewhat, and some investors, clinging to the hope that the worst was over, even bought back some of the stocks they had sold in a panic. However, this sense of relief would prove to be short-lived. The reprieve offered by the bankers' intervention would be fleeting, a mere pause before the storm's fury. Tuesday, October 29th, 1929. A date etched in history as Black Tuesday, a day that witnessed the most devastating stock market crash in American history. The panic that had been simmering for days reached a fever pitch as investors rushed to unload their holdings at any price. The trading floor of the New York Stock Exchange descended into chaos. Sell orders flooded the market, overwhelming the capacity of the exchange to process them. By the end of the day, over 16 million shares had changed hands, a record at the time. The crash of 1929 was in full force, marking the beginning of the Great Depression. The shockwaves from the stock market crash reverberated far beyond Wall Street, spreading like a contagion through the American economy. Banks, heavily invested in the market, faced massive losses and began to fail. Businesses, starved of credit and facing plummeting demand, were forced to lay off workers or shut down entirely. Unemployment soared, reaching unprecedented levels. Breadlines, once unimaginable in the land of opportunity, became a common sight in cities across the nation. Families were evicted from their homes, unable to pay their mortgages or rent. The American dream, which had seemed so attainable just a few weeks earlier, turned into a nightmare for millions. Behind the cold statistics of the stock market crash lay countless stories of individual loss, despair, and shattered dreams. Ordinary Americans, many of whom had invested their life savings in the market, saw their hopes and aspirations vanish overnight. Farmers, already struggling with low crop prices and mounting debt, were hit particularly hard. Unable to sell their crops or make their loan payments, many lost their farms and were forced to migrate in search of work. In cities, families struggled to survive. Men, once proud breadwinners, now stood in unemployment lines, their self-esteem shattered. Children, their innocence lost amidst the hardship, went hungry and lacked even the most basic necessities. The stock market crash of 1929 marked the beginning of a long and painful economic downturn that would come to be known as the Great Depression. The initial shockwaves of the crash quickly rippled through the American economy, leaving a trail of devastation in their wake. Banks, weakened by losses in the market and a wave of withdrawals from panicked depositors, began to fail at an alarming rate. With banks unable or unwilling to lend, businesses, already struggling with declining sales and mounting inventories, found themselves starved of credit. Factories idled, businesses shuttered, and unemployment soared to unprecedented levels. What had begun as a financial crisis on Wall Street quickly transformed into a full-blown economic depression that gripped the entire nation. The American dream, once a beacon of hope for millions, seemed to vanish overnight, replaced by a harsh new reality of breadlines, soup kitchens, and widespread suffering. President Herbert Hoover, elected just months before the crash on a wave of prosperity, found himself ill-equipped to deal with the magnitude of the economic crisis that engulfed his presidency. A staunch believer in limited government intervention in the economy, Hoover initially downplayed the severity of the situation, assuring Americans that the downturn was merely a temporary setback. He clung to the belief that the economy would eventually right itself through the natural forces of the free market. Hoover's reluctance to embrace more aggressive government intervention blinded him to the depth of the suffering and the need for a more forceful response. His policies, often seen as too little too late, failed to stem the tide of the Depression, further eroding public confidence in his leadership. As if the economic woes weren't enough, a natural disaster of epic proportions descended upon the American heartland, compounding the misery of the Great Depression. A severe drought, coupled with decades of unsustainable farming practices, transformed the once fertile plains of the Midwest into a vast dust bowl. Topsoil, depleted of moisture and its natural anchors, was swept up by relentless winds, creating massive dust storms that blackened the skies and choked the life out of the land. Crops withered and died, livestock perished, and families, their livelihoods destroyed, were forced to abandon their homes and seek refuge elsewhere. The Dust Bowl exodus, a mass migration of desperate farmers and their families fleeing the ecological devastation, became a defining image of the Great Depression. As the Great Depression deepened, it exposed the fault lines in American society and fueled social unrest. The gap between the haves and the have-nots, already widening in the boom years of the 1920s, became a chasm, breeding resentment and a sense of injustice. Labor strikes, once a rarity, became more frequent and more militant as workers clashed with employers struggling to stay afloat. Protests and demonstrations, fueled by hunger and despair, erupted in cities across the nation, challenging the status quo and demanding action from a government perceived as indifferent to their plight. The seeds of change were sown, creating fertile ground for new ideas and a new kind of leadership that promised a more active role for government in addressing the needs of its citizens. In the midst of the despair and uncertainty of the Great Depression, a new leader emerged, offering a message of hope and a promise of a new deal for the American people. Franklin Delano Roosevelt, elected president in a landslide victory in 1932, promised swift and decisive action to address the nation's economic woes. Roosevelt's New Deal, a series of programs and reforms designed to provide relief, recovery, and reform, marked a turning point in American history. While the New Deal did not single-handedly end the Great Depression, it provided a lifeline for millions of Americans, offering jobs, financial assistance, and a renewed sense of hope. It fundamentally reshaped the relationship between the government and its citizens, laying the foundation for a more active and interventionist role for government in addressing social and economic challenges. The crash of 1929 shattered the illusion of unending prosperity, casting a long shadow over the world. It exposed the fragility of economic systems and the human cost of unchecked speculation. Lessons learned continue to resonate, serving as cautionary tales and guiding principles. Black Tuesday became synonymous with the perils of excessive risk-taking and the importance of government oversight. The echoes of that day led to the creation of institutions and regulations to prevent a repeat of the Great Depression. The Great Depression, a period of unprecedented economic hardship and social upheaval, left an indelible mark on the American psyche. It tested the nation's resilience, challenged its values, and ultimately forged a new sense of purpose and a renewed commitment to social justice. The despair and suffering of the era, though profound, also ignited a spirit of innovation, compassion, and collective action that would shape the course of American history. The New Deal, President Franklin Delano Roosevelt's ambitious response to the crisis, represented a fundamental shift in the role of government. It ushered in an era of greater government intervention in the economy, with programs and policies designed to provide relief, recovery, and reform. Social Security, a cornerstone of the New Deal legacy, provided a safety net for the elderly, the unemployed, and the disabled, transforming the relationship between the government and its citizens. The Works Progress Administration, another New Deal initiative, employed millions of Americans in public works projects, building roads, bridges, schools, and hospitals, leaving an enduring legacy of infrastructure and public art. These programs, while not without their flaws, provided a lifeline for millions and demonstrated the potential for government action to address social and economic challenges. Black Tuesday, a stark reminder of the fragility of economic systems and the human toll of financial crises, continues to hold relevance today. The 2008 crisis echoed the 1929 crash, highlighting global market interconnectedness and the risks of unregulated speculation. Lessons from the Great Depression serve as a cautionary tale for policymakers, investors, and citizens alike. Financial regulation, the dangers of excessive debt, and the need for a social safety net remain crucial today. As we face new challenges, the lessons of Black Tuesday remind us of the importance of responsible stewardship and collective action. The echoes of that fateful day urge us to build a more resilient and equitable future for all.